Bismillahirrahmanirrahim. This is the second video on financial statement analysis. And in this video, we will discuss the extent to which market prices are reflected by the accounting information links. Next, we will discuss how the six steps analysis and valuation process captures each of these four links. Next, we will look into few industry traits that influence how firms develop strategies, their profitability, growth potential, and risk levels, impacting the patterns observed in their financial statements. Finally, we will talk about the tools for assessing the economic characteristics that drive competition in an industry. Please like, subscribe, and share my channel to search for accounting lessons and hit the notification bell button to alert you for the latest video. For all of your questions, comments, and suggestions, please put them in the comment section below. And for webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Accounting is a K. We hope that this video helps students in their academic development and teachers in enhancing their lesson plans and teaching methodologies. The degree to which market prices accurately reflect the implications of accounting information depends on four critical links: accounting system. It converts a company's transactions into financial fundamentals like earnings, cash flows, and equity value on its financial statements. Then analysts and investors, they study these financial statements to grasp the firm's profitability, growth prospects, and risks. The third critical link is expectations. Analysts and investors then translate these fundamentals into predictions of future earnings and cash flows, which in turn influence their estimates of the company's stock value. The fourth link is market pricing, that is, trading activities in the market adjust stock prices based on these estimated values. So, in essence, the degree to which market prices accurately reflect accounting information depends on how well these four stages link together, from accounting data through analysis and expectations formation and to actual market pricing of stocks. Next, let us discuss how the six-step analysis and valuation process captures each of these four links. On the right side, the six-step process is addressed. Understanding industry competition, evaluating the firm's competitive strategy, and how sustainable its advantages are. In step number 3, we review the accounting information in financial statements to ensure accuracy. We evaluate how well these statements represent the firm's actual financial status and performance. In step number 4, we use various ratios to examine the firm's financial statements. We analyze profitability, growth, and risk trends over time and compare them with industry peers. In step number 5 and 6, we predict the firm's future activities and use projected financial statements like balance sheets and cash flows Based on these projections, we estimate future earnings, cash flows, and dividends to determine the expected share value. On the left hand side, the firm creates shareholders' value through their business activities like financing, operations, and investing, aiming to gain a competitive edge in the industry. This setup helps us to understand how firms create shareholder value through effective industry competition analysis and strategy evaluation. Financial reporting is the first link or the first step in the share pricing process. Accountants translate the firm's business activities into financial statements such as balance sheets, income statements, cash flow statements, and notes. These statements serve as a credible way for the firm to communicate essential information to stakeholders about its financial status and performance. The second link is the share pricing process. In the share pricing process is the financial analysis. Here, investors and analysts study the firm's financial statements to gain insight into profitability, growth prospects, and risks. These factors are key determinants of the company's share value. In the third link of share pricing, analysts forecast future earnings, cash flows, and dividends using the firm's financial statements. They then estimate the firm's share value based on these forecasts, taking into account the firm's risk factor. In the fourth link, markets share pricing process, analysts and investors translate their estimated share values into real share prices by trading. Buying shares they see as undervalued should raise prices towards that value, while selling shares they view as overvalued should lower prices. The bottom right shows the result of 6-step analysis and valuation. Buying shares when we believe they are priced below their fundamental value, and selling them when we believe they are priced above it. The classic strategy of buy low and sell high. The links between firm activities and share prices are not always smooth. Financial reporting and accounting may miss some transactions and challenges, affecting how well financial statements reflect profitability, growth, and risk. Accounting principles generally don't directly include future events that impact firm value, and companies vary in the data they have for forecasting. Market factors like sentiments, noise trading, and frictions can cause prices to briefly differ from true value, especially during bubbles. Our six-step analysis and valuation process evaluates these links to find shares that might be temporarily mispriced, whether too high or too low. We will use financial information from Starbucks Corporation to illustrate our six-step analysis and valuation framework. Starbucks is chosen as our main example for three reasons. First, most readers are likely familiar with Starbucks, the world's largest chain of coffee shops. Second, Starbucks financial statements exhibit varying level of accounting quality, with some aspects showing high quality and others showing poor quality. We will be using the 2015 financial data when the Starbucks shares were priced at 56.84. We will analyze whether this price is fair, was fair, too high or too low. Should we buy or sell Starbucks shares at this price? Through the six-step analysis and valuation process, we aim to provide a clear answer to these challenging but important questions. Next, let us look into few industry traits and competition greatly influence how firms develop strategies, their profitability, growth potential, and risk levels impacting the patterns observed in their financial statements. We will pinpoint the company's strategies for gaining and sustaining a competitive edge in its industry. For example, this exhibit presents the financial data from four different industries as percentage of revenues. These numbers illustrate how industry specific factors affect the financial statements. Let us see how the economic trends of these industries impact their financial statements. Look at the grocery store chain. Now, the grocery store chain faces tough competition with similar products, making theirs essential commodities. Entry into the industry is easy, requiring mainly retail space and access to food distributors. It faces low barriers to entry, just requires retail space and access to food distributors. Grocery store chain operates with a 3.5% profit margin, earning 3.5 cents per dollar of revenue. Efficient asset utilization of 0.34 in assets generates $1 in annual sales. Assets turnover, that is 100 divided by 34.2, 2.9 times, that is in each dollar in assets generates a $2.9 in annual revenue. Overall, it earns 3.5 into 2.9, that is 10.15%, 10.15 cents in profit for every dollar invested in assets annually. In pharmaceutical company, barriers to entry are high. It requires substantial investment in research and development for new drugs with uncertain outcomes. Research and development processes are lengthy and risky. Few projects succeed in developing new drugs. Drugs must undergo extensive government testing and approval processes. Successful drugs receive patents granting exclusive rights for several years. Profit margins are higher than grocery stores. Pharmaceutical firms, you can see, has achieved 12.1% of profit margin. Risks include product liability and competition from superior drugs. Pharmaceutical firms tend to use less debt financing compared to industries like electric utilities and commercial banks due to business risk. Power generating plants dominate the balance sheet of electrical utilities. Historically, demanded and granted by government regulators, it allows to set rates for electric services. However, monopoly positions are being phased out, introducing competition that lowers profit margins and affects rate settings. Traditionally, high profit margin to compensate for low asset turnover, you can see 100 divided by 202, that will be 0.495. In this case, uh, then reduce financial risk, and it helps um, reduce financial risk rather helps in significant investments in long term assets. They often have high debts in their capital structure. Uh, then commercial banks primarily invest in financial securities and make loans to businesses and individuals. Banks funds operates through customer deposits and short-term borrowings. They invest in securities that can be quickly converted to cash due to withdrawal flexibility of customer deposits. Banks typically earn a small profit margin on lending activities with higher margins from fee based services such as financing structures, guarantees, and mergers. They have low asset turnover. If you look over here, it will be 100 divided by 36.1, that will be 0.09 times per year. That indicates they rely on interest and fee revenues from its investments and loans. Banks generate significant profit margins through fee based services rather than traditional lending activities. Next, let us talk about the tools for assessing the economic characteristics that drive competition in an industry. We will analyze Starbucks' position in the coffee beverage industry using Porter's 5 forces framework, industry value chain analysis, and economic attributes evaluation. We will also talk about the microeconomic frameworks for comprehensive industry analysis. Porter identifies 5 forces that impact competition and profitability in an industry. 3 forces: rivalry among existing firms, potential entry, and substitutes focus on horizontal competition among current and potential competitors. The remaining two forces, buyer power and supplier power, address vertical competition from suppliers to buyers through existing firms. We will discuss these forces within the context of the coffee beverage industry. So let us start with the existing rivalry among rivalry among existing firms. Is intense competition among existing firms in the coffee beverage sector. Starbucks competes globally with global fast food chains, McDonald's and Subway, and other coffee and donut chains like Dunkin' Donuts and Tim Hortons. Specialty coffee brands like Panera Bread, Peet's, and Caribou Coffee, and numerous local cafes. Despite being a mature market, the industry still presents growth opportunities. There is significant growth potential in countries like China and India. Threats to entrants is high in the coffee beverage industry due to low barriers to entry like minimal capital investment, technological expertise, patents and or low regulatory hurdles. Established brands like Starbucks and McDonald's enjoy strong brand recognition, reducing the threat of new competitors. Easy market entry allows both existing major players and new firms to compete by opening coffee shops. The industry is characterized with high competition from potential entrants due to ease of market entry. The threat of substitutes is high in the coffee beverage industry due to a wide range of substitute beverages. Consumers can easily switch to alternatives such as soft drinks, Coca Cola, Pepsi, fruit juices, bottled water, sports drink, tea, milk, and others. So, depending on the occasion, consumers may choose substitutes like caffeinated soft drinks in the morning or alcoholic beverages in the evening instead of coffee. Coffee faces competition from major global players offering substitute beverages such as Coca Cola, PepsiCo, Nestle, etc. Then, buyer power is low in the coffee beverage industry, as although the industry is competitive with many rivals and substitutes, individual consumers buying coffee are generally price takers rather than price setters. Individual coffee consumers exhibit low price sensitivity due to the relatively small dollar amount of their purchases. Large retail chains like Walmart, which makes significant national level purchases of coffee for resale, can exert substantial buyer power due to their scale and purchasing volume. The supplier power is low in the coffee beverage. Green coffee beans, the primary input of coffee production, are agricultural commodities traded globally. As such, coffee bean suppliers do not wield significant power over pricing. Unlike industries where few suppliers dominate, example software or microprocessors, the coffee industry benefits from numerous suppliers across coffee producing regions globally. So, to summarize, there is intense competition um, among direct rivals and substitutes in the coffee beverage industry. There is continuous threat of new entrants due to low barriers to entry, low buyer power among individual consumers, but larger retail and grocery chains wield some influence. Coffee bean suppliers have low power due to the commodity nature of green coffee beans. So, next, let us talk about the value chain analysis. Now, value chain describes the sequence of activities from creation to distribution of products or services in an industry. It helps identify where value is added within the industry and strategic positioning of firms. The coffee beverage industry value chain begins with coffee farmers growing green coffee beans. These beans are harvested, shipped, roasted, and packaged for distribution. Packed beans are sold through retail grocery stores or coffee shops to consumers. And then consumers brew coffee at home or enjoy prepared beverages in coffee shops. Most value is created in retail sales of coffee through grocery stores and coffee shops. Farmers struggle to capture significant value due to commoditization of coffee beans. Shipping, roasting, packaging, and distribution are mainly logistical and add less overall value. The Starbucks business segment operates in countries like America, China, Europe, Middle East, East Africa. So Starbucks focuses on high value retail stages in the coffee beverage value chain. The channel development segment distributes Starbucks branded products through various retail outlets and enhancing value capture. To conclude, Starbucks has strategically positioned itself in high value retail stages of the coffee beverages value chain to maximize value capture and market presence. Finally, let us talk about the economic attributes framework. Number one is demand. Are the customers highly sensitive to price changes? Example, automobiles. Or relatively insensitive? Example, soft drinks. Is demand growing quickly? Example, long term healthcare. Or stable, mature? Example, grocery stores. Does demand fluctuate with economic cycles? Example, construction. Or remain steady? Example, food products or medical care. Is the demand seasonal? Example, summer clothing, ski equipments. Or consistent year round? Example, most grocery products. Then supply. So, are there many suppliers offering similar products or just a few offering unique products? Are there significant barriers to entry preventing new entrants or just a few offering unique products? Sorry, um, um, are there significant barriers preventing new entrants or can newcomers easily enter the market? Are there high costs to leave the market? Example, cleanup cost for mining, nuclear plants, or relatively low cost. Coming to manufacturing, is the manufacturing process heavily reliant on capital? Example, electric power generation, labor, etc. Labor, or a mix? Example, automobile manufacturing. Sorry, is the manufacturing process complex with low tolerance for errors? Example, microchips. Or simpler with acceptance quality ranges? Example, apparels. Coming to marketing, is the product marketed to businesses requiring sales staff or consumers using advertising, brand names, retail locations? Does demand naturally flow through distribution channels or must firms actively stimulate demand? Finally, regarding investing and financing, are industry assets short term, example commercial banks, or long term, example electric utilities? Is there low risk, example minimal technological obsolescence, allowing for high debt financing? Or high risk, example short product life cycles requiring more equity financing? Is the industry stable and profitable, generating excess cash flow, example for investments? Or is it expanding rapidly, necessitating external financing? So, this framework provides a structured approach to analyze industries based on critical economic factors that influence competition, profitability, and operational strategies. So, this completes the second video on financial statement analysis. I hope you have enjoyed this presentation, and if you found value in this video, then please like, subscribe and share my channel and hit the notification bell button to alert you for the latest video. For webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question or any suggestion regarding this session, then please put them in the comment box below or by email, and inshallah I will reply you back. Thank you so much and happy learning.